In this week's video, we'll review the latest charts and data to help us answer the question: successful retest for stocks or much lower lows? In many respects, we'll be updating and revisiting topics that were covered on September 2nd. While it may not feel that way at the end of the week, stocks were up on Monday of this week, and then we got a hot inflation number on Tuesday morning. And you may remember before that CPI number, we said we were really in no man's land with competing themes. We had a lot of data in hand that supported the bullish case, primarily the thrusts, and plenty of things to be concerned about. These bullet points proved to be helpful this week, especially this point here and this point here. Now, if we were to objectively look at these cases here, top of the screen, bottom of the screen, right here, inflation remains sticky. That was a key point for the bearish case. It's hard to make the argument that the CPI data this week assisted the bullish case in any way. Thus, probably fair to say all of this remains relevant going into next week. And even after the horrible CPI data on Tuesday, until Friday's session, the S&P 500 was able to remain above 3,900. The FedEx news after the close on Thursday changed all that, and on Friday we closed below 3,900, but still remained a good bit above the June low in the S&P 500. However, if you're familiar with Dow theory, it's noteworthy that the Dow Jones Transportation Average here made a new low for the year, and at the close on Friday, undercut the June low on a closing basis. Hard to make an argument that that's a bullish development economically or for the markets. And as we mentioned, the CPI data earlier in the week seemed to align with this bullet point here. The same can be said for the FedEx information that we got on Thursday. Bloomberg headline from Friday: FedEx misses the worst Deutsche Bank analysts have seen in 20 years, which speaks to earnings. Thus, relative to no man's land and the bullish case and the bearish case, in the next segment of the video, we'll be looking at market charts to try to help us with these questions related to inflation, the June low in the S&P 500, the economy, and the Fed. Quick tactical note for clients: on Friday we bought a position-traded money market. We're trying to make our cash work a little bit harder until the markets can find a bottom. If you want to do a little research on it, here's the ticker symbol right here. It's a weekly chart of the NASDAQ Composite Tape Index. It's a long-term view of that data. You can see for the most part during the financial crisis, it never turned up on a weekly basis. And then the week of April 17th, down here after the low that was made in March of 2009, it did turn up. We look at the same data this week. We had a positive look here similar to the look from April of 2009, but we've given that back now. It's hard to make an argument that this is a constructive look. There's a monthly look at the global advanced decline line, so global market breadth. Struggling look, dot-com bust, struggling look in here, financial crisis, double bottom look here in 2016. This is a weak market. Can make an argument we have a similar look in the present day. Month to date, this was positive just 2 trading days ago, or at least on the 13th. As of the close on the 15th, it had flipped over to red. This needs to improve. NASDAQ monthly during the session on Friday, September 16th, rolling over here down near the lower Bollinger Band. RSI down here below 50, tried to pop back up to 50 and was rejected. You can make an argument it's similar to this look in here, and make an argument that it could be somewhat similar to this look in here. Bottom line, this is a fact. We've never had RSI stay below 50 this long since the major low in 2009. 2008, we're below here, the 200-week moving average right here. Your rate of change is down here. You can make an argument that this is a similar rate of change look here and similar look here below a flattish 200-week moving average. This point in here could be similar to this point in here, and it's not really similar at all to any of these looks in here. NASDAQ 100 weekly, RSI here, financial crisis, RSI in the present day. Here's where we take a big leg down in 2008. You can see here the slope of the upper Bollinger Band here looks worse today than it did right in here. Also hard to make an argument that this is a bottoming look here, this is a bottoming look here, that we look similar on September 16th. Very, very similar concepts here. You can pause your video player. Based on some simple math tied to interest rates, you can make an argument that the S&P 500 could fall an additional 20%. Where do we stand relative to the average and median drawdown tied to the breadth thrust that we recently covered? Here's the look here as of the close on September 16th. This is not a good look here. Here's your average and median drawdown here. Came back up into it, looked like we're rejected. We also came back to this trend line, and it looks like we were rejected. Last week we talked about 50-day moving averages that were still up from a slope perspective. Now we have numerous 50 days with a starting to possibly roll over look. These breadth thrusts aren't necessarily dead, but they are seriously on the ropes again. Those odds would improve if the market could make some kind of stand here, maybe between 3,800 and 3,600. Even still, a drop from 3,900 to 3,600 is a pretty significant drop. I covered this in the past. I'll move quickly. This is tied to August 5th breadth thrusts here. Possible support as of September 2nd. Had a nice bounce at a logical area September 9th. And then if we fast forward to today's close, we're below the upward sloping trend line. Nothing earth-shattering, but it speaks to probabilities. Relative to the drawdowns, the worst case scenarios were down here around 3,600-ish. Some reference points that we covered in recent weeks. This is the close on September 16th. Always want to keep an open mind about a wide range of outcomes, and from a risk management perspective, it's good to understand history. Covered this in early September. When the S&P 500 is down 10% or more at the end of August, as it was this year, the additional average and median drawdown based on historical outcomes all the way down near 3,200. Not a prediction in any shape, form, or fashion. We're just speaking to history. Also noteworthy, we covered those inverse breadth thrusts back in June, the average and median outcome there all the way down near 3,000. These type of looks, based on something that's happened in 2022, tell us we have to respect downside risk. Also extremely important to keep in mind, something similar to these signals over here happened in the present day. Same with these signals down here. Remember, there's some overlaps. These dates are here twice. We know that. Yes, there can be significant drawdowns here, but typically there is another side. So this is based on a quarterly drop of 15% or more, and this is based on 2 consecutive quarters where your drop is 20% or more. In 2022, we checked both boxes, hence the overlap. The additional drawdown in those historical cases from an average and median perspective around 3,700 here, and possibly undercutting 3,600. We'll move quickly here. This is designed so you can pause your video player. You can make an argument that the present day look has some similar characteristics to 2015 and 2008. This chart looked like a bottom a few weeks ago, is starting to drift from that script. These lines show major lows in the stock market. If you know your stock market history, in every single case, at some point relatively close to the low, this data improves. It hasn't improved yet, and that would just be a baby step. If it starts to improve, it doesn't mean the low is in, but it's going to be very, very difficult to have a significant and lasting low without seeing this line turn up. Looked like a bullish breakout, now it looks like a failed breakout. Helps us keep a handle on risk appetite. Somewhat of a mixed bag here. You make an argument that's a left shoulder, that's a head, and maybe we're forming some type of right shoulder. We're still in a range here, but with a vulnerable look. Friday's close, we lost these levels in here on the NASDAQ and also lost this upward sloping trend line on RSI. Pause your video player here. We'd like to see more from weekly RSI than we've seen thus far. Flipping through a wide range of weekly charts on Thursday evening, this term up here came to mind relative to the number of bearish engulfing candles. This shows exactly what happened this week. The market was bullish Monday heading into CPI, and then it changed its mind in a big way. This candle here engulfs this candle here. That's a setup. It's a bearish setup. You need follow through. That means the next candle needs to come down here. That's to be determined. This area in here was relevant in recent weeks. Now we're below it. This was the rally off the June low, broke the upward sloping trend line. Now we're back below this area up here, which still represents possible resistance. Dow Jones Composite, the broad composite, is the weekly look. Here's your engulfing look here. Momentum, this is not a particularly attractive look. This is at the end of the week as of the close on September 16th. In a nutshell, what this tells you is this cross here tells you this is a counter trend rally within the context of a downtrend, a weekly downtrend, because we're below zero. What you want to see at a real low is that you sustain the move. Now that we're possibly going to get another bearish cross, possibly, if you're down here on MACD, it says you're resuming the downtrend. To be determined. Broke a trend line, lower high, lower low. Here's the constructive look well before the S&P 500 bottoms in the financial crisis. Today, we really don't look like that yet. Once again, similarities between this point, this point, this point, and this point. Another bearish engulfing weekly here below the 200-week moving average. We were unable to recapture the 200-week. This looks different from this. Very similar concepts here. As of Thursday's close, here's the rally off the June low. A to B move. We have now undercut the 38.2, 50%, and 61.8% retracements. The longer we stay below them, the more relevant it becomes. This is Thursday. The industrials lost an additional 139 points as of the close on Friday. It's not difficult to make the case that this is a topping pattern here on the NASDAQ 100 relative to the S&P 500 that started over 2 years ago. Here's your long-term moving average rolling over. It looked like we were going to try to break this trend. It's just not a constructive look at this point. Similar concerns in here. NASDAQ 100, bearish engulfing weekly, still above an upward sloping 200-week. NASDAQ 100 from last week's video, pre-CPI. So this is a week ago today. Chart here is dated September 9th. Firmly in no man's land. This is Thursday's close, and this is Friday's close. A common theme. Price here still holding around this gap down here for now. Still represents possible support. From a trend perspective, not a particularly good look breaking the trend line, not being able to break this downward sloping trend line. We've got a downward sloping 200-day and what appears to be a now rolling over 50-day here in blue. This is somewhat of a trend convergence look here. Longer term trend, intermediate term trend. The longer this remains, the more concerning it becomes. Volume by price tells us that this is an important region, and here we held near this region here. If this doesn't hold, somewhat of an air pocket look here relative to volume by price. Still well above the June low. Long way to go until the end of the month. Good to know you don't want the present day to take on this type of look here. Another rollover look here potentially. We held in here before. If this doesn't hold, here's your air pocket, and it brings you down to that cluster that we've talked about numerous times. This is all hypothetical. NYSE Composite, Thursday's close, Friday's close. Pause your video player here and make some unflattering comparisons. S&P 100 megacaps, break a trend line. This is a lower high relative to this high, and now we have printed a lower low. The 50-day looks very vulnerable in here. The broad S&P 1500, 50-day flattening out, rolling over. We've lost this trend line from the June low. S&P 10-minute, Thursday's close. The bad news was we lost these areas in here. The good news, this is still potential support in here. Probably fair to say a pretty significant change relative to intermediate probabilities here and here. Another look where you can see that 50-day rolling over. Still in the range of this gap here. Possible support. There's that 23-day roll look that we talked about 2 weeks ago. You can see volume by price. We made a stand in here before. A little bit of an air pocket look in here if this doesn't hold. That's to be determined. You can see it on the weekly chart here. Volume by price. A little bit of an air pocket in here if these levels don't hold. This is not a good look here with the 23-week moving average. Covered it 2 weeks ago. It still looks similar to 2008. That doesn't mean we're going to follow the same path. S&P 500 weekly, bearish engulfing. Good to know. You can make a case that a break of this level here, about 38.15, could open the door to 3,200. If you compare the look of the Bollinger Bands here relative to price and RSI, you can make an argument there are some similarities to 08, 2000 to 2002. Still holding this level here, so that would be good news. This is concerning here with weekly momentum rolling over. And from a secular trend perspective, we're still above an upward sloping 200 week that sits now at 35.79. This is about 7.5 to 8% below the close on September 16th. S&P 500 equal weight, it's a common theme. Trying to bust through resistance here recently. That failed. Just not a good look. And if you can go up very, very rapidly, you can also fall very, very rapidly. Not a prediction. Interest rates above the trend line going back to 1962. 2-year yields, which speak to Fed expectations. Is the Fed done yet? Still firmly in an uptrend. Concerns would increase if we saw a spike here. We do not have it yet. VIX weekly, this could be your cup. This could be your handle. If you're a stock market bull, you really don't want to get into this white space. The VIX was up 15.4% for the week. Talked about this recently and said it could go either way. It looks like it's trying to hold this trend line. That would not be good for the bullish case. The VIX of VIX, here's that big spike before this huge drop here in 08. We don't have that in the present day as of the close on September 16th, but the last time momentum got up into this area here, we did see a spike. We closed above 0.8 on Friday. 10-2 yield curve at a very, very, very rare level, knocking on the door of a very rare level. Last time we were here, year 2000, here's the S&P 500. Probably fair to say the closer this spread gets to negative 0.5, the higher the probability that the U.S. economy is going to go into a recession sometime in the next 6 months, which just happens to be one of the bullet points underneath the bearish case. This is gold in isolation. This is all the way back to 2020 here. This is a long-term consolidation box atop. The longer we stay below this area of consolidation, the more concerning it would become. High-yield bonds weekly finished down over 2% for the full week. That's not a particularly encouraging look. Little bit of encouragement here. Finished the day positive on Friday, but still really in no man's land over here. Another read on software, IGV, bearish engulfing occurring below the 200 week. This is a setup. On Friday, we closed below these red lines. The longer we stay below them, the more concerning it would become. Can make an argument this is your top and this is your double top. Corporate bonds bottom before the stock market in 08. Simultaneously at the COVID low, this week making a new weekly lower low. As we talked about, constructive. You can pause your video player here. Triple Qs divided by high yield bonds. This is a risk on look in here. This is a risk on look in here. This is a close-up of the present day. While HYG was positive during Friday's session, this ratio was down 0.95%. Really, everything you need to know is right here. Ditto until it improves. Always important to head into Monday with an open mind, still near this gap. Covered these concepts in the past. If you're looking for some bullish hope, this looks pretty good here. What you don't want to see is a bullish breakout. Now we're giving up this line here. This ratio was down fairly big on Friday. If you're a stock market bull, what would concern you is if we drop like a stone down to here. Hasn't happened yet. SH ETF 8-day all the way out to the 138-day. Question, can you visualize a full-bore bullish look? Answer, yes. The longer this holds, the more meaningful it becomes. Pause your video player, similar. Same can be said for this ratio, not a good look in its present form. Pause your video player, this is a risk-off look in here, somewhat similar in the present day. Covered this in the past. You get a breakout, you get a breakout, S&P weak, S&P weak. We've been watching this. This didn't look too bad right here, but now it's starting to move in the wrong direction for stock market bulls. Tech versus the S&P 500 as of a close on Thursday, still holding above these dotted lines for now. Same ratio, got a little bit of a bounce on Friday, but we're still below these levels here. Tech Weekly bearish engulfing. Momentum looks worse than the S&P 500. Blue, the fastest moving average, has moved from the top rapidly to the bottom. Price is below all of the moving averages, still holding the gap for now. Like high yield bonds, the semiconductor index, or the SOX, was positive on Friday, up 0.53%. That sounds pretty good, but we have to take into account that it was down for the full week, 5.83%. And the 50-day moving average is also very vulnerable here to rolling over. 50-day closed lower than it did the day before. Thoughts on semis and high-yield bonds? Some good, some not so good. Also from the some good, some not so good file, the market finished well off of its lows on Friday. It's possible that that was tied to options expiration. So the rally off of the low would be the some good, but we still finished down 28 points. Some not so good. We'll be watching the math in our models closely. Somewhat of a rollover look here now. The outcome of this type of battle in the next week or so is going to be very, very important. S&P 500 index daily as of the close on Friday, September 16th. Left side of your screen. Simple 8-day moving average all the way out to the 250-day moving average in teal for illustrative purposes only. Price closed below all of the moving averages. Blue, the fastest moving average, closed on the bottom. Not all of the slopes are down, but we're pretty close. In its present form, if we were asked on a multiple choice test, does this look closer to a full bore bearish look or a full bore bullish look? It would be very, very easy. We would check bearish and we would move to the next question. That's based on the chart in front of us. Right side of the screen, very, very similar concepts. 8-day, in this case, out to the 138-day in teal. Once again, the fastest moving average blue was on top recently with price above it. Now we have a sharp reversal and we have price below all of the moving averages, and for the most part, they're all vulnerable or down. Same question on the test here. You would check closer to a full bore bearish look and you would move on. Now let's take the longer term set of moving averages on the left side of the screen, 8-day to the 250, and revisit a case that we've covered in the past, the 1962 case. If you know your market history, it is a double bottom. Here's your first bottom, here's your retest look in October, and eventually price moves in this direction and gets back above all of the moving averages. So this is a 10-month period here in 1962. The low is in here. This is a 10-month period in the present day as of the close on the 16th. Yes, there's potentially some similarities here, but these trends are significantly different. This is a much weaker trend here. The first push off the low gets nowhere near the 250-day moving average. In the present day, we went up very, very close to the 250-day here and were rejected. In this case, in the first pass, we were rejected at a downward sloping 100-day. So there are some similarities, but there are some significant differences between these two periods. But what we can learn is, from a trend perspective, this is not particularly encouraging. This is a full-bore bearish look for the most part. So we have to be open to some type of catalyst flipping the script. If you're bullish, you basically want to get up here. It has a lot of work to do, but we could have said the same thing here, and that helps us keep an open mind. Same concepts here with the 8 to 138. If you're going to get a double bottom look, price has got to get out here in the present day relatively soon, and that's quite possible. You only need to rally to about 41.50 to get back above all of these moving averages from the 8 to the 138. Moral of the story, this helps us understand what it would look like to flip quickly back to a bullish scenario. And it also helps us understand that the present day chart looks vulnerable. Something has to change for the bulls. And that may happen very, very soon. It just hasn't happened yet. Probably a good time to get the pause button ready. You can also Google titles if you want to look at this information in more detail on the net. Multiple capitulation indicators are now flashing a warning sign. That means the likelihood of retail capitulation increases significantly near term should equities retest this year's June lows. From an odds perspective, what that says is it's possible the June lows will not hold. The economy remains resilient. Talked about the yield curve earlier. This also speaks to recession probabilities. On the inflation front, there are a lot of experienced, intelligent people that can make rational arguments that inflation should drop like a stone relatively soon. And we can also find experienced and intelligent market participants that can make the case that inflation will remain sticky. The Fed believes the labor market is the key to bringing inflation down. This is not particularly good news here, and this is not particularly good news here. This also speaks to a very strong labor market. Two of the objectives of this move: to attract and retain talent. Extremely important not to forget the lessons from the 1970s. This helps us with the case that inflation could fall relatively soon. Another concerning topic that's good to be aware of: shouldn't be making any assumptions about where rates and inflation are headed. It's always good to understand present-day circumstances in the context of history. In every instance here, you can pause your video player. You can also Google titles to find the original articles. Important quote here: my experience with inflation is that some of the components that were very strong in today's report, meaning Tuesday's report, they tend to be sticky and have a lot of inertia. So I would expect those to remain pretty strong in the coming months. Good to respect a wide range of outcomes, including the arguments that inflation should fall relatively soon. Another topic that's good to be aware of: we covered these bullet points before CPI. If you look at them objectively, it's impossible to say this week was a good week for these bullet points up here. It's fairly easy to say that this week was constructive relative to these bullet points down here. All of this, especially this here, still relevant heading into next week. Thus, many of the concerns from September 2nd still remain. The longer we remain below 3,900, the more relevant it becomes. It's probably fair to say at this point that something fundamentally has to improve for the bulls, and that may happen. Some possible bullish catalysts, and these can also be bearish catalysts as well. Fed meeting September 21st. PCE deflator, which is an inflation data point coming on September 30th. This is something the Fed watches. Next read on CPI, October 13th. And it's possible that if we get extremely weak economic data, the data just falls off the table, that could cause the Fed to pivot, but that's not really likely at this point. The most likely scenario is that we see some improvement here or here, and that helps the market with Fed expectations. It never hurts to prepare for a wide range of outcomes, including the bullish flip similar to the 1962 case. But the facts are, at this point, during the current rally, the long-term trends never flipped. And unless something changes, it looks like we're getting a convergence of trends, and it is not in a bullish manner. We could go through a wide range of charts and data points, and many of them we've covered in the past. You can make a strong argument that the market could find support between 3,700 and 3,600. You can also make a very, very strong argument it may not find support until 3,400 to 3,000. As of Friday's close, hypothetically, that represents an additional drop of 12 to 22%, which is why risk management is still potentially extremely important. Just as we don't want to get stuck on any story, we don't want to get stuck on any S&P 500 level, including the one shown on the screen. For the most part, these topics, the economy, inflation, interest rates, and the Fed, for the most part, that's one intertwined topic. And there are countless permutations and combinations of what could happen economically, what could happen relative to inflation, what that does with rates and Fed policy. The Nasdaq, the Dow, and the S&P 500 are all above an upward-sloping 200-week moving average. With what we've seen thus far, you can't really say the secular bull is dead, and for us that really doesn't even matter at this point, because if the secular bull is alive, then the markets will turn and the charts and data will start to improve. That may happen. It hasn't happened yet. We've talked about this for several weeks. This was extremely helpful on Tuesday when CPI came out. It's just one example of why it will continue to be extremely important walking forward. And as we all know, none of this is going to work unless we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.